My name is Andrew Stotts of the Valuation Masterclass, and tonight we're going to have a presentation by one of our students on the company Fastenal, and it's going to be interesting. I know he's worked a lot on this, and so before we get into that, let me introduce you to him. His nickname is Benjamin, and he is going to present Fastenal, as I said, and of course he's got a team behind him that have, also been working on the same company and supporting each other. Remember that the next Valuation Masterclass Bootcamp starts in 68 days, and you can get a $1,900 discount now. This offer lasts for 7 days. Just go to the website and use BC23 Live, which is what you're on right now, or scan the QR code, and we'll see you there. So I am going to now bring Ben in. All right. So how you feeling?
I'm feeling good. I'm ready.
Yeah, I don't think you can get any more prepared than you are right now. How many hours, if you look at your accountability sheet, do you remember roughly how many hours you're at now?
To be honest, I can't remember, but at a minimum, I would say like at least 1 hour, at least an hour. But at most, I think one day I put in 7 hours at once. But
Right.
this weekend I definitely put in like 3-4 hours total. Yeah.
Good, excellent. So I'm going to pull up the screen, and let's get this up here. Good. So I'm going to exit and then let you get started. So you ready?
Super. Let's do it.
Okay, I'm exiting now. You can start now.
All right. Hi, I hope everybody's doing well. So Fastenal, strong business model, but soft outlook. What do I mean by this? Well, you're about to find out soon. My name is Benjamin Lewis McMullen, and I will be presenting my equity valuation report on Fastenal Company. So I initiate coverage on FAST with a sell recommendation based on a target price of $33. And this implies a downside of 20%. And I derived my target price from a DCF-based valuation using a WACC of 8.2% and a terminal growth rate of 3%. And there's three main key highlights I want to talk about today. At first, being sowing on-site momentum weakens Fastenal's growth structural growth advantages. And secondly is SG&A growth threatens Fastenal's ability to expand their margins. And lastly, slower cash conversion and rising CapEx needs pressure their long-term cash generation. And for my risk, the main core risk could be summed up to being strategic risk. But before we understand anything, we have to understand what Fastenal does first. So, Fastenal is a distributor of industrial and construction supplies specializing in fasteners, safety products, and maintenance, repair, and operation essentials. And Fastenal's main market is the US. And as of third quarter this year, they operate 1,590 branches and 2,031 on-site locations internationally, and this nets them revenue of over $6 billion US. And for my key highlights, they talk about tighter margins and cash flow capping the long-term upside. So let's get into my first highlight. Slowing on-site momentum weakens Fastenal structural growth advantages. So their outlook has become less certain as the company struggles to keep pace with their targeted expansion of customer sites. And as of 2025 this year, they had to reduce signings for the Fastenal managed inventory device as their signing activity moderated again after 2 strong years. And at the same time, their continued growth in large on-site and national account customers brings them lower margins due to one, aggressive pricing, and secondly, a heavier mix of non-fastener products. And with these, I forecast that gross margin could be capped at 46% even as revenue grows around 8.5% between 2027 to 2029 as the sector recovers. And in terms of cost, let's look at my second highlight. Cost threatens Fastenal's ability to expand margins. So as of 2024, their SG&A grew faster than sales due to ongoing investments. And the company cautions that these pressures could persist moving forward. And with manufacturing currently being down, there is end market softness from their biggest clients, which limits the potential for revenue driven operating margin into 2026 by reducing the demand for their OEM products, which are higher margin by nature. And, although they meant to combat this with their fastener expansion project, which was meant to increase margins, these gains were ultimately offset by lower margin customer site growth and inventory drawdown costs. And with these trends, it leads me to forecast that their EBIT margin is to remain constant around 21% all the way through to 2029. And for my last highlight, slower cash conversion and rising capex needs pressure their long-term cash generation. So I forecast a decline in their cash conversion due to growth in their customer sites, bringing larger accounts and an increase in inventory heavy non-fastener categories, which increases both their account receivables and inventory. And at the same time, right now, Fastenal is also entering a period of higher capital spending to support their growth. So, with this, I expect that the increase in working capital and capex, while margins remaining the same, to create downward on their future cash flow. But how does Fastenal fit in the bigger picture? So, let's look at the industry. We can see that Fastenal is part of the industrial distributor sub industry, which in the US market, in terms of market cap, is being led by players like Ferguson, Fastenal, and Granger. And currently, key players are leveraging technology to help transform the distribution process, which in turn support the long-term growth of the industrial distribution market, which is projected to grow from around 8 trillion US dollars to 12 trillion US dollars by 2033. But how's Fastenal done lately? So, as of the third quarter, they showed margin pressure despite rising sales. So, what do I mean by this? So, we can see from the box above that total revenue grew 12% year on year to around 2.1 billion US dollars, which was supported by one, stronger daily sales, and secondly, customer wins. But despite this, Fastenal's growth and operating margins have remained flat year on year, and this in turn caused their net margin to only change by 10 basis points. And ultimately, this was caused by an offset due to growth among large, lower margin on-site type customers. And let's check out their latest news. Let's start off with the good news. Everybody loves good news. So, Fastenal expanded their on-site network and continued investing in their FMI and automation to raise digital adoption, which leads me to my second news. How, as a result, digital channels have exceeded 60% of sales, and this just reinforces the customer stickiness. And however, not so good. My last news is that management noted that with soft manufacturing conditions, they are limiting demand for fasteners and OEM related categories. But what does the market expect? So let's take a look at consensus. So around 61% of analysts right now maintain a hold recommendation on Fastenal. And this results in a mean target price of $44, which would offer a 7% upside from the current price. But let's take a look at where all of this begins, the revenue. So as of 2024, non-fasteners accounted for 69% of total sales, while fasteners accounted for 31% of total sales. And this just shows they are indicating to expand into safety, PPE, and other industrial supplies. And as for their tech-enabled channels, they've generated 60% of sales, the rem- while the sorry while the remaining 40% of sales are from traditional channels such as branches and manual orders. And for their customers, we can see that 75% of their customers are from manufacturing, while non residential construction is 8.5%, with the remainder consisting of resellers and other small projects. But let's see how all of this translates into the FEMR investing framework. So we can see that overall, Fastenal appears relatively attractive compared to 1,690 non-financial companies. This is on the basis of fundamentals, valuation, momentum, and risk. And I want to focus on three of them. So let's take a look at the good ones first. For their fundamentals, they've ranked in the top 10% in the US due to strong profitability. And this was brought on by, as you can see, high and consistent operating margin and return on assets. And to support this, we can also see that for their risk, their balance sheet risk is quite low as they're not highly leveraged and they can cover their interest, as you can see with the current ratio. But however, what's not so good is their valuation. It's slightly less than average as they trade on a high price to earnings and price to book relative to other companies. But now, let's see how they compare to others. Are they the worst or are they the best? So with the world-class benchmarking, we can see that profitable growth has consistently ranked in number one in the past 12 months. And we can see that a main driver on this, on the left side, is due to their profitability. While we can see that on the right side, their growth leaves room for future improvement as it's slightly less than average. But what do I expect moving forward? So in the profit and loss statement, I forecasted that revenue will increase year on year from an increase in customer sites, and this causes their revenue to go from 8.2 billion US dollars in 2025 to 11.3 billion dollars in 2029. But when it's all said and done, how much cash do they actually have left? So let's take a look at their free cash flow, where, as I talked about earlier, I expect an increase in net working capital over time due to the longer cash conversion, along with an increased capex from their investments in fixed asset. But despite this, we can still see that free cash flow is still healthy, it remains positive, and it increases year on year. But in terms of price, how do they compare to others? So let's look at relative valuation, where we can see that on a price to book multiple, Fastenal appears as expensive relative to the others. Because, I mean, looking at the chart below, we can see that Fast is nearly double of the USA and nearly 4 times compared to the world. But on the bright side is I expect the return on equity to be well above their peers. But when we consider these two in the PB to ROE multiple, we can still see that they appeared overvalued. And to support this, we can look at the PE multiple where they still trade at a notable premium. And on top of this, I expect their EPS growth to remain negative through to 2026, and this is due to margin pressure and slower on-site expansion, as highlighted before. And on top of this, there was also a stock split, and in turn, this renders the PEG ratio not meaningful, and it can't be used. Now, looking at the intrinsic valuation. So for my absolute valuation, I assume the risk-free rate of 3.5%. With a market equity risk premium of 6.5% and a beta of 0.8. And this results in a cost of equity of 8.4%. And as Fastenal operates with minimal financial leverage, I use the capital structure with around 3.4% debt. And with a cost of debt of 3% and a tax rate of 24%, this results in a weighted average cost of capital of 8.2%. And subsequently, I applied a terminal growth rate of 3% and used free cash flow to firm as my primary valuation method. And I derived an equity value of $33 as a result. And for the dividend discount model and free cash flow to equity, they yielded values of $25 and $32 per share respectively. But one key thing we can see is that across all methods, as we can see at the bar chart, they still remain below the current market price, and this makes it seem as Fastenal appears overvalued. But since valuation is driven by assumptions, let's stress test those assumptions. So my sensitivity analysis shows that upside still remains limited across most scenarios, and this is due to persistent pressure on their margins and slower expected growth. But now let's look at the key risks that would affect my valuation. So the key risks are core risks. And let's start with my first risk where slow on-site and digital expansion. How does that play into it? So if signings were to slow, or if new sites were to take longer to reach full productivity, the company could fall short of its expected sales. And in addition to this, the operating margin also relies on service efficiency at these customer locations for revenue. So weaker utilization or slower expansion could add cost pressure to their margin. And on top of this, there is also rising competition in their industry, which could hamper their future success. As the landscape is pretty dynamic, these companies could also expand towards similar on-site or digitally managed systems over time. And this brings overlap that lengthens Fastenal's sales cycle, raises customer acquisition costs, or it could mess with their pricing flexibility. And for my last key risk, weak industrial manufacturing could reduce their profitability. And why do I say that? It's because as of 2024, manufacturers account for more than 70% of their revenue. And with the company's embedded customer sites softening the impact, I still believe that a broad and prolonged downturn in manufacturing could limit their volume growth and reduce their utilization at customer locations. And before I conclude my presentation, I just want to say that with my expectations of margins being capped and even as revenue grows over time, and that leads me to think that their strategy could be weakening. And until they could reverse these challenges on or pressures, we might say, on their margins, along with their price seeming overvalued, in my opinion, is that downside risk could dominate the outlook. And that concludes my presentation. And now I will be welcoming any questions.
Oh, we got a lot of questions. Well done. All right, let's get into the questions. So the first one says you argue on-site momentum is weakening, but Fastenal's signings historically fluctuate quarter to quarter. What makes you confident this isn't just noise rather than some structural slowdown?
I mean, yeah, I looked at both, on a quarterly basis, but one trend that I think is when we look at on an annual basis, cut out all the seasonality, their growth is declining, and I mean, it's just poor timing on their part. It's more of bad luck because they've tried to expand and COVID hit,
Mm.
and now with the tariffs and manufacturing being down, so it can't be faulted to them. But I think on an annual basis, it's going down, and that's why management decided to reduce their target for signings for FMI devices.
Okay. And Arush says if Fastenal can post double-digit growth in weak PMI, what realistic catalyst do you see that would force meaningful multiple compression?
Okay, what do you see that would force meaningful multiple compression? Uh, what do you mean by would force meaningful multiple compression?
In
But
other
okay,
words, basically what he's saying is it's going to cause the share price to fall, right?
okay,
So, you're saying you're negative, but
yeah,
come on, the company's done pretty well in a very tough
yeah.
time. So, is there something that may come out that would spook the market?
Oh, okay, yeah, because I think I remember looking at this as quarter three. I think their fastener expansion project, as I mentioned before, quarter three, it actually did pretty well, as we saw like a 12% increase in the daily sales rate of fasteners. But I also read that uh, you can look at it as not being quite successful because a 12% increase is pretty big in terms of daily sales, but the gross margin only increased like 0.2% if I could recall, and that was because of inventory drawdown costs, which I saw. It was inventory they bought in like 2020 or 2021. And now, as they're letting go of this inventory, it results in pretty high cost of goods sold, and that really compresses their margin. And I believe until they can get rid of all this inventory, I don't see their margin improving. And I feel like that's what hurts their stock price. Because if they can get this under control, I don't see why their stock could increase its fair value.
Mm, okay. And Arush also asks, with on-site adoption and customer integration still growing, What evidence shows Fastenal's long-term growth durability is weakening?
Uh, I would say that's a good question, but uh, I mean, as I was doing my valuation, you know, I mean, I was looking at how they could succeed, and I mean, I had my doubts because with the industry being quite fragmented, there's a lot of major players that could do the same, and what we've seen is that uh, their peers started doing the same too. Although it's not as heavy as Fastenal, I feel as the time for Fastenal to really like be on top of this trend is now, and I feel like if they can't get it right now, this would hurt them in the long term.
Okay. And this is the last one from Moment. Given Fastenal's low beta and near zero leverage, isn't 8.2 an overly high weighted average cost of capital? At 7%, valuation would likely rise towards 41. What are your thoughts about what your weighted average cost of capital, your cost of equity really is what we're talking about, because there's not really any
Yeah,
debt.
that's because I assume uh that the market return would be 10%, because even if the rates drop in the if the rates would drop, you know, in the coming weeks or months, I assume that long term this is what the market return would be, and
Mm.
that was my valuation horizon, I would say.
Okay. So how does it feel to finish this presentation and this assignment?
It feels great, you know. I put a lot of time into it. I invested a lot of time, and I'm thankful for all the feedback and the help, and it just feels truly amazing.
Yeah. And how would you describe, the difference, the transformation, or the difference between you on day one when you arrived to our kickoff session and today?
I think it's the confidence, you know, because when you work on something, you become more confident on in your abilities to do those things. And I feel with that the valuation masterclass, you know, we get a lot of opportunities. You know, nobody's stopping us from like volunteering.
Mm,
And what I really like is uh I mean, you could say it could be better in an internship because you're actually getting the chance to do it and receive
mm,
feedback on a weekly basis. And
mm.
I feel like that's contributed a lot in terms of, you know, just really building my confidence and, you know, not being scared to volunteer and just grow.
Yeah. Well, it's exciting, and you've done a great job. The report was great, and I know last Friday when we had our feedback Friday, you it was questionable, but you
Yeah.
pulled it out. And one of the great things about the Valuation Masterclass Bootcamp is that we have great graduates, as well as, of course, Momin, who can help every step of the way. And for me, that's probably the best part about it, is building a community of people who really support each other. And I hope that you are involved in that too when you finish and graduate, that you are contributing to the community.
I would love to be a part of it. I mean, it's truly life changing.
Yeah, it's great. All right, I'm gonna let you go, and now it's time to go and relax a little bit.
Well, thank you.
Yep, and
It
we'll
was
see you.
fun.
Yep, we'll see
See
you
ya.
in Slack. Yep, take care. Well, that was quite a comprehensive presentation. We've just seen both the buy side and now the sell side of that, to say it's a sell. And I just want to remind you, that was Ben. He did a great job on it. And we've got 68 days to the next boot camp. Remember, you get a $1,900 discount right now. And that's just using the BC 23 Live, which is what you're on right now, code at checkout. And I hope to see you there. The whole point of what we're doing with the Valuation Masterclass Bootcamp is trying to help people build a competitive advantage in company valuation. And that competitive advantage is going to help them either, number one, get a job in finance, number two, advance their career in finance, and number three, switch their job from an accountant or an engineer to become a financial analyst or work in the financial industry. And it's exciting to see the progress. Keep in mind that Ben didn't ever write this kind of research before, and he only knew about this company only about 4 weeks ago, three weeks ago. So incredible work. I hope to see you in the Valuation Masterclass Bootcamp.